Today I'm going to cover the Bank of Japan issue, the carry trade issue, what shook the world markets last Monday, and I think it's very significant. You may not know the term carry trade or could explain it, but I'll try and I'll have someone else who will explain it and why this is significant. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is August 13, 2024. The Bank of Japan their interest rates have been significantly below the U.S. and the European Central Bank, which are the other two primary central banks in the world. What they have done to prop their currency up for a long time, at least a couple of decades, is they have borrowed money against their currency, borrowed yen, and turned around and bought the US dollar or the euro. There are probably some other currencies. So the information I got was just other currencies, but the currencies that are the strongest, which probably are the dollar and the euro. And that propped their currency up. Well, what happened is this last week, all of a sudden, the interest rates on their currency all of a sudden went quite high, higher than ours. So all of a sudden, their currency is being devalued heavily, and because they leveraged themselves to make these purchases, they basically probably got a margin call. And that sent their currency sideways or down, and it really shook the world markets, because the carry trade has been for a long time been essential to the Japanese market, which is a major market in the world. So now we've got the unwinding happening, and I'm going to play this for you, play you two pieces today. It's all on the carry trade and the unwinding of currencies. And this is not good. It's going to happen, I think. My opinion is it'll happen over a long period of time, probably years. So don't expect something tomorrow. But there will be, the currencies of the world are at risk. Our currency, I don't know the current number. I'm sorry, I don't know. It's around 9 trillion. Of printed money, nothing behind it. We had money behind the currency in the early 70s when we went off the gold standard. We had a certain amount of gold. I think it was around 8,000 tons. It had come down from 16,000 because of, European countries trading dollars for gold. But we went off the gold standard and stopped that. And so it was around 8,000. I have no idea what it is today. There is no audit. There is no verification. If you're skeptical, like I am, you may think, yeah, good luck. I bet there's not 8,000 tons there. Maybe not. But at least we have stabilized that. And everything that happened beyond that, all the printing that happened from the time in the early 70s, from the time that we went off the gold standard, we've, printed trillions of dollars and did not buy 1 ounce of gold additional to what we had at that time. So all of the printed money, the pieces of paper that you have in your wallet, are worth nothing unless you and I agree that they are worth something. There was the original amount of gold, so I shouldn't say they're worth nothing, but they're worth very, very little, because the buying power of the dollar has so eroded from that time that it is literally worth pennies on the dollar. From 1913, from the establishment of the Federal Reserve to today, approximately 95% of the value of the dollar has eroded. So it's worth approximately 5 cents on the dollar. What is it from the early 70s to today? It's worth a little bit more than that, but there's been a lot of decline in the value of the dollar. And so what Japan is facing is a collapse of its currency, collapse of the Bank of Japan. And this is mentioned in the video I'm going to play, mentioned a couple of times. One of them you'll hear, and if you listen to the entire video, I'll put it on the channel or in the video if you want to go look at it. You'll see it's mentioned more than once that basically the Bank of Japan, which means their currency, is collapsing. And this is not good because it's not just, oh, it's Japan, they've got a problem. It's this, they're like the third largest central bank in the world. So they're a significant player, and whatever happens there is going to have a ripple effect. So I do think that world currencies are going to have shaking, and there will probably be some kind of a reset. We've also started to see the issue of currencies with, I think there's 43 nations right now that are buying oil in their currency. We, the U.S., and our currency, the U.S. dollar, are the reserve currency of the world. That was established in 1944. And we have had for 40, 50 years, we have been, we struck a deal with Saudi Arabia that they would only sell oil in dollars. And in exchange for that, we would back them militarily. So that's called the petrodollar. And so these countries, some of them are developed, some are undeveloped. They have gone against that, and they've struck a deal directly with Saudi Arabia, and maybe with other countries, but Saudi Arabia for sure, to, like, we'll buy your oil, but you've got to accept our currency. It could be rubles or, yuan or whatever pesos, whatever that currency is. Okay, we'll buy it, but you have to accept our currency. Saudi Arabia caved and said, okay, I'll accept your currency. So no longer, we may be the reserve currency, kind of in name only, but the petrodollar is being, which has propped up our currency, is kind of eroding. And so this whole thing is going on right now. This is this year and last year. So the issue with the Japanese currency, the yen, is significant, obviously significant for them, but significant for the rest of the world. So I want to play a piece. This is done by Michelle Makori. She is a reporter. She works for Kitco News right now. She has been with major networks. She's from South Africa. She's Israeli. So she's got a perspective around, from Israel, South Africa, and I think she's in New York right now. And so she has definitely an international perspective, and she is interviewing Ed Dowd. And he has a finance background. He seems to know a lot about this. I thought she did a good interview, and he had some good things to say. A good explanation of the carry trade and what's going on with Japan. So I condensed this down to about 5 or 6 minutes. So the interview is much longer. So, but if you'll bear with this, I think you'll learn something and his perspective on it. So take a listen.
Hello, I'm Michelle Makori. Thank you again for joining us. With the interest rates at the highest level in 23 years for over a year now, markets have been bracing for the economic impact of that strain, for the Fed to break something. My next guest says that the Fed did indeed break something, and that was another central bank. The Fed broke the Bank of Japan, and now the clock has started counting down towards a global debt crisis. Here to explain this and more and give us his outlook on the markets, gold and Bitcoin, is Edward Dowd. Ed is the founding partner of Finance Technologies. He's over 3 decades of experience in finance, including working as a portfolio manager at BlackRock, the world's biggest asset manager. He's also the author of Cause Unknown. Ed, nice to have you back with us. Thanks for joining us again.
Michelle, great to be here. Thanks for having me on again.
Ed, very good to have you back with us. Before we get into where we are now with the Fed and the Bank of Japan and interest rates, I want to pick up where we left off last time. And you were on in late March of 2023. We just had 3 of the 4 largest bank failures in US history were in the midst of the banking crisis. And you were expecting an emergency rate cut by July from the Fed following those banking collapses. Now, instead, we got the Bank Term Funding Program and other creative solutions, but there was no rate cut. In fact, the Fed hiked rates. There were 3 more 25 basis point hikes after that, with rates peaking at the 5.25% to 5.5% range about a year ago, and the Fed has held steady since. So let's begin with what happened there, why you weren't correct, why didn't that rate cut happen, in your opinion?
Yes, Michelle, we did have a misstep in our prediction. We were wrong on the interest rate cuts. They, in fact, raised a few more times. The good news is they prevented a bank run. The Federal Reserve instituted the Bank Term Funding Program because the assets in their held-to-maturity account were way underwater, and people were starting to get nervous, and that's why we had those bank failures. So what the Fed did is lent the banking system short-term loans to prevent these bank runs, and they unfortunately took away those loans in March 11th of this year. They ended the program, and at the time that we made the call, the credit markets hadn't yet deteriorated. Now we are in the part of the economic cycle where credit is deteriorating, and the Fed is not going to give loans against bad credit on the bank books. So that's one thing we were wrong on. The other thing we were wrong on, we were calling for a recession in Q3 and Q4 of last year. Our economic cycle indicators, which is our proprietary black box leading indicators, showed a recession coming in that time frame. And what happened in October, along with the Federal Reserve's Bank Term Funding Program, the government went on a spending. Seeing the deficit explode, they juiced the economy and they created government jobs. At the same time, they were also manufacturing payroll numbers. It's been well documented that the payroll numbers have been revised down after every month to the tune of 1.5 million jobs. So, and Jerome Powell recently even stated the payroll numbers are in question. 2 meetings ago, he indicated that there's some question about that. So what we did get in our economic indicators starting in October was a bounce. And we saw our economic indicators bounce. But what's important to understand is they bounced and never got above the 0 line, which is expansion. So whatever the juice that the government did and the Fed fixed, it kind of didn't get us into expansion. It kind of delayed the recession, so to speak. And our economic indicators started rolling over again in March. They've gone down every month since March. And then here we are going into the most controversial election ever, and something broke. And our expectations before the Bank of Japan crisis was that we were going to see a little correction into the election, then a rally out of the election, and as the economy continued to weaken, we would see the real problems emerge. What just happened in Japan took a lot of us by alarm, and we now think that the clock has been set for the global unwind of the debt, and it's going to, in conjunction with a weakening U.S. economy. So what we don't know are what the policy responses are going to be on the other side of this, which are coming and have to come. One more thing, as soon as the markets blew up last week or into this week, the expectations quickly went to emergency rate cuts. The Federal Reserve came out on Monday and indicated they're waiting for more data. The Fed is loath to lower interest rates, primarily because once the global financial markets catch wind of the Fed lowering interest rates and ending the rate hike pause, and we'll see a big correction in risk assets, which they want to avoid.
Next, Tom Lee is being interviewed by Scott Wapner, and he asked him, really, what do you think is next after this carry trade issue with Japan? And I thought, and Tom Lee, the reason I wanted to play this is because he gives a positive answer. He says, I think this is really the direction from here because the volatility index has come down so far after going up so far that he said basically things are probably going to be positive from here. So But they do talk about the unwinding of the carry trade. And he mentions at the end of it that he mentions Professor Jeremy Siegel from the Wharton School and Ron Insana, who was a former host at CNBC, that they want a Federal Reserve that is forward-looking. I think last week I played a piece from Mohamed El-Arian, and he said the same thing. He says, I hate the fact, in so many words, I hate the fact that the Fed is always looking back. Data dependent. And the data is old, it's stale. So they could take a forward look. Many people do take a forward look at it, but because they are so reactionary, again, it came up in the Tom Lee interview. He even said, I wish we had a forward-looking Fed. So I'll play this. This will give you another perspective, but I think some interesting information on the Japanese carry trade issue.
It does take us to our talk of the tape, the market's next move, and whether this rebound really can be trusted. We're all wondering that, of course. So let's ask Tom Lee. He joins us now live. Welcome. It's good to see you.
Great to see you, Scott.
So I look at your notes today, and you suggest the worst is behind us. What makes you think that?
Well, I think the thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind. But I think the worst of the selling pressure is behind us.
How do we know that we had just a growth scare and not something more dramatic to come, Tom? Never mind the unwind of the carry trade, and no one really knows whether that's over either. But when you think about those two events, what does it make you think about where we could go moving forward?
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday. And a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds. And next Thursday, they'll get another weekly claims number. And if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade? I mean, there's no real tell as to whether that's run its course, and that seems to be, the obvious catalyst at the beginning of the week for positioning being well offsides, and it just needed to correct itself. Has it finished?
Scott, that's a great question. Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive, because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
Well, I just want to continue this. You suggest, if it unwinds in a messy way, there's no if. I mean, we saw at least the first reverberations from that unwind, and that was anything but orderly. What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that is been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if it's if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Yeah. What do you make of how this week began? Not with necessarily the market upset, but the commentary around it, whether it was Jeremy Siegel of the Wharton School suggesting the Fed needs to come out and do a 75 basis point cut in an emergency way. Of course, he walked that back with our own Jeff Cox yesterday evening. Ron and Sana at the beginning of the week suggesting the Fed needs to come out and say something that essentially we've got your back from a liquidity standpoint. Do they need to do something before September's meeting?
Scott, I think both comments from both Ron and Jeremy Siegel are actually valid. But to me, what it speaks of is I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear is we're data dependent, so that by necessity they're going to be very late. I think it's actually encouraging to see this sort of pushback.
Okay. You can take a look at that. Thank you for watching. If you have questions or comments, feel free to leave them in the comment section below.